I need to tell you something that might surprise you about one of the most misunderstood sectors in the entire stock market. For decades, I avoided aerospace and defense stocks. I watched them from afar, studied their financials, analyzed their competitive positions, and kept my checkbook closed. People thought I simply did not understand the industry. They thought the Oracle of Omaha had a blind spot for anything involving technology or government contracts, but they were wrong. I understood the industry perfectly. I understood it well enough to know that most aerospace companies were terrible investments. They were capital destroyers, masquerading as growth stocks. They consumed enormous amounts of cash, faced brutal competition for government contracts, and operated with profit margins that would make a grocery store look attractive. But something has changed over the past decade. A handful of aerospace companies have transformed themselves into exactly the kind of businesses I have always loved. Businesses with durable competitive advantages, businesses with pricing power, businesses that generate enormous amounts of free cash flow. And today, I am going to share with you the only 3 aerospace stocks that I believe are worth owning. Let me take you back to 1998, because that year taught me everything I needed to know about why most aerospace investments fail. I was studying a major defense contractor that everyone on Wall Street was recommending. The company had just won a massive government contract worth billions of dollars over 10 years. Analysts were falling over themselves to upgrade the stock. The narrative was irresistible. Guaranteed government revenue for a decade. How could you lose? So I did what I always do. I ignored the narrative and studied the numbers. I read every contract document I could get my hands on. I analyzed the company's historical performance on similar contracts. I looked at their cost structure, their capital requirements, their competitive position. And what I found horrified me. Yes, the company had won a $10 billion contract, but to fulfill that contract, they would need to invest nearly $8 billion in new facilities, equipment, and working capital. The profit margin on the contract, after accounting for all those capital requirements, was barely 4%. 4% return on a contract that would tie up the company's resources for a decade. I could get a better return from Treasury bonds with zero risk. But it got worse. I discovered that the company had won the contract by underbidding their competitors. They had promised to deliver at a price that assumed everything would go perfectly. No cost overruns, no technical problems, no delays, no inflation in labor or materials costs over 10 years. Anyone who has ever built anything knows that nothing ever goes perfectly. And sure enough, within 3 years, the company was reporting massive losses on that contract. They had underestimated costs by billions of dollars. The guaranteed revenue that Wall Street celebrated had turned into guaranteed losses. The stock collapsed. Investors who bought based on the contract announcement lost 70% of their investment over the following 5 years. That experience crystallized something I had suspected about the aerospace industry. The problem was not the products or the technology. The problem was the business model. Most aerospace companies operate as cost-plus contractors. They bid for government work, often underbidding to win the contract, then try to make money by controlling costs during execution. But governments are terrible customers. They change requirements constantly. They add specifications mid-project. They demand modifications that increase costs but refuse to increase payment proportionally. And because these contracts often span many years, inflation erodes whatever profit margin existed at the start. The result is an industry filled with companies that look impressive on the surface, but destroy shareholder value over time. They report billions in revenue, but the cash never materializes. They announce contract wins that Wall Street celebrates, but those wins turn into losses when execution begins. They require constant capital investment just to stay competitive, but they never generate enough return on that capital to justify the investment. This is why I avoided aerospace for so long. Not because I did not understand it, but because I understood it too well. I knew that the typical Aerospace business model was fundamentally broken for shareholders. But I also knew that if I could find aerospace companies that had escaped this broken model, companies that had built genuine competitive advantages, companies that generated real free cash flow, those companies could be extraordinary investments. Because aerospace has something that few other industries have: massive barriers to entry. If you want to compete with Coca-Cola, you can start a beverage company tomorrow. It might fail, but you can try. If you want to compete with a major aerospace company, you need billions of dollars in capital, decades of engineering expertise, relationships with governments around the world, and regulatory approvals that take years to obtain. The barriers to entry in aerospace are almost insurmountable. And that means the companies that have built strong positions in this industry can maintain those positions for decades. So let me tell you what I look for in an aerospace company, because understanding these criteria is essential to understanding why I have selected these three specific stocks. The first criterion is aftermarket revenue. The aerospace companies I want to own do not depend primarily on selling new aircraft or winning new government contracts. They make their money on the aftermarket, on maintenance, repair, and overhaul, on spare parts, on upgrades and modifications to existing fleets. This aftermarket revenue is far more predictable than new equipment sales. When you own an aircraft, you must maintain it. There is no choice. Regulations require it. Safety demands it. Insurance mandates it. And in most cases, you must use original equipment manufacturer parts and certified service providers. This creates a stream of recurring, high-margin revenue that continues for the entire life of the aircraft, which can be 30 or 40 years. This is the business model I love. Sell the initial equipment, then generate decades of high-margin aftermarket revenue. The second criterion is intellectual property and certification. The aerospace industry is heavily regulated. Every component that goes on an aircraft must be certified by aviation authorities. This certification process is expensive and time-consuming, often taking years. Once a component is certified, competing products face the same lengthy, expensive certification process. This creates an enormous moat around existing products, even if a competitor could make a better or cheaper component. Getting it certified and accepted by airlines and aircraft manufacturers is so difficult that few even try. The aerospace companies I want to own have vast portfolios of certified products and the engineering expertise to keep those certifications current as regulations evolve. The third criterion is diversification across platforms and customers. I do not want to own aerospace companies that depend on a single aircraft program or a single government customer. I want companies that supply components to dozens of different aircraft, both commercial and military, with customers around the world. This diversification provides stability. If one aircraft program gets canceled or one customer cuts spending, the company's overall business continues with minimal disruption, and it provides growth opportunities. When new aircraft programs launch, these diversified suppliers are well positioned to win content because of their existing relationships and proven capabilities. The fourth criterion is free cash flow generation. I have said this many times, and I will say it again. The value of any business is determined by the cash it generates over its lifetime, discounted back to today. Aerospace companies that win contracts but do not generate cash are worthless to me. I want companies that convert their revenue into free cash flow at high rates, cash that can be returned to shareholders or reinvested in high return opportunities. And the fifth criterion is management that thinks like owners. Aerospace companies face constant temptation to chase revenue growth by underbidding on contracts or making acquisitions that look good in press releases but destroy value for shareholders. The management teams I want to own are disciplined about capital allocation. They walk away from bad contracts. They only make acquisitions at reasonable prices. They return excess cash to shareholders rather than empire building. With these 5 criteria in mind, let me tell you about the 3 aerospace stocks I believe are worth owning today. The second stock I would own is General Dynamics. Now, before you say anything, I know what you might be thinking, Warren. General Dynamics is a defense contractor. Did you not just spend several minutes explaining why defense contracting is a broken business model? Yes, I did, but General Dynamics is not a typical defense contractor. General Dynamics has built its business in segments of defense where the economics are fundamentally different, and they have combined that with a commercial business that is simply extraordinary. Let me start with Gulfstream, because Gulfstream alone would justify owning General Dynamics. Gulfstream manufactures business jets, and they dominate the large cabin segment of that market. When Fortune 500 CEOs and billionaires and heads of state need to fly privately, they buy Gulfstream. The brand is synonymous with excellence in business aviation. But here is what makes Gulfstream special from an investment perspective. The backlog as I speak to you today. Gulfstream has a backlog of aircraft orders stretching years into the future. Customers have literally placed orders and deposited money for aircraft that will not be delivered for 3 or 4 years. This backlog provides extraordinary visibility into future revenue, but more importantly, it provides pricing power. When demand exceeds supply by this much, Gulfstream can raise prices, and they do. The average selling price of a Gulfstream jet has increased substantially over the past decade. Far outpacing inflation, customers pay because there is no comparable alternative. If you want the best, you buy Gulfstream and you pay whatever they ask. The aftermarket opportunity on Gulfstream jets is enormous. These aircraft cost $50, $60, $70 million and have operating lives of 25 to 30 years. During that time, they require constant maintenance, regular overhauls, avionics upgrades, interior refurbishments. Gulfstream captures a significant portion of this aftermarket spending through their service network. This is high-margin, recurring revenue that continues for decades after the initial aircraft sale. Now, let me tell you about General Dynamics defense businesses, because they are not typical defense contractors either. General Dynamics has 4 defense segments: combat systems, which makes tanks and armored vehicles; marine systems, which builds submarines and surface ships; technologies, which provides its services; and mission systems, which makes communication and computing systems. What makes these businesses different is their competitive position. In submarines, General Dynamics is one of only 2 companies in the United States with the capability to build nuclear-powered submarines. There is no competitive bidding that drives margins to zero because there is no one else to bid. The barriers to entry are insurmountable. You cannot just decide to start building nuclear submarines. It would take decades and tens of billions of dollars to develop the capability, even if the government allowed it, which they would not. The same dynamic exists in tanks and armored vehicles. General Dynamics operates the only remaining tank production facility in America. When the Army needs tanks, there is one place to get them. This is not cost-plus contracting where margins get squeezed by competitive bidding. This is sole source contracting where the company has pricing power because there is no alternative. The cash flow generation at General Dynamics has been exceptional. The company generates billions of dollars in free cash flow annually. They have used this cash to pay consistent dividends that have increased every year for decades. They have repurchased enormous amounts of stock, reducing share count and increasing per-share earnings. They have made disciplined acquisitions that added capabilities without overpaying management. General Dynamics understands capital allocation at a level that few defense contractors do. I want to tell you a story about General Dynamics that illustrates why I trust their management. Several years ago, General Dynamics had an opportunity to bid on a major government contract. It would have been the largest contract in company history. Wall Street was expecting them to bid aggressively and win. Instead, management walked away. They determined that the contract terms were unfavorable, that the profit margins would be too thin, that the risks were too high. They chose discipline over growth. The stock initially dropped when they announced they would not bid. analysts downgraded them for lack of growth ambition. But you know what happened next? The company that won that contract suffered exactly the problems General Dynamics predicted: cost overruns, technical challenges, margin pressure. Meanwhile, General Dynamics continued generating strong returns from their existing businesses, and the stock more than recovered. That is the kind of management I want allocating my capital looking forward. General Dynamics benefits from several powerful trends. Defense spending globally is increasing as geopolitical tensions rise. The submarine program is ramping up with Virginia-class boats and the new Columbia-class ballistic missile submarines. Gulfstream is launching new aircraft models that will extend their leadership in business aviation. And the installed base of aircraft and military equipment continues requiring aftermarket service. This is a business built for long-term compounding. The first stock I would own in aerospace, and the one I consider the most attractive of the three, is TransDigm. I know many investors have never heard of this company, but TransDigm might be the finest business model in all of aerospace. Let me explain why. TransDigm manufactures proprietary aerospace components. When I say proprietary, I mean components where TransDigm is the sole source supplier, not the preferred supplier, not the low-cost supplier. The only supplier when an airline needs a specific actuator or a specific valve or a specific latch for their aircraft. And TransDigm makes that component. The airline has exactly one option: buy from TransDigm at whatever price TransDigm sets. There is no negotiation. There is no competitive bidding. There is no alternative. The component is designed into the aircraft, certified for that specific application, and cannot be substituted without going through a lengthy and expensive recertification process that no one wants to undertake. Think about what this means for pricing power. Most businesses face constant pressure from customers demanding lower prices, from competitors undercutting on bids, from purchasing managers whose entire job is to squeeze suppliers. TransDigm faces none of this. Their customers have no leverage because there is no alternative supplier. When TransDigm raises prices, customers pay. They complain. Certainly there have been congressional hearings about TransDigm's pricing practices, but at the end of the day, the customers pay because the aircraft does not fly without the component, and the component only comes from TransDigm. Let me give you some numbers that illustrate how extraordinary this business model is. TransDigm operates at EBITDA margins of approximately 50%. 50% in aerospace manufacturing, for context. Most aerospace companies operate at margins in the single digits or low teens. TransDigm operates at 5 times those margins because of their proprietary positioning. Their free cash flow conversion is equally impressive. The business generates billions of dollars in free cash flow annually from a capital base that requires minimal reinvestment. They are not building factories. They are not investing billions in new aircraft development programs. They are harvesting cash from their installed base of proprietary components. I want to tell you how TransDigm built this extraordinary position because the strategy is brilliant. Over the past 20 years, TransDigm has acquired over 80 aerospace component businesses. Each acquisition follows the same pattern. They identify businesses that make proprietary components with sole source positions. They acquire those businesses, often from larger aerospace companies that do not fully appreciate what they have. Then they apply what they call their value creation strategy. They cut unnecessary costs. They optimize operations. And most importantly, they raise prices to levels that reflect the true value of sole source proprietary positioning. The previous owners often underpriced these components because they did not understand the pricing power inherent in proprietary aerospace parts. TransDigm understands it perfectly. The aftermarket mix at TransDigm is extraordinary. Over 50% of their revenue comes from aftermarket sales, maintenance, and repair parts for existing aircraft. This aftermarket revenue is remarkably predictable and remarkably profitable. When an aircraft is in service, it requires parts. There is no deferring this spending. Airlines cannot simply decide not to maintain their aircraft. Regulations require it, safety demands it, and when they need a TransDigm component, they buy it from TransDigm's price. The commercial aerospace cycle does create some volatility in TransDigm's business. When airlines are doing well, they fly more, which means more wear on components, which means more aftermarket sales. When airlines are struggling, they might defer some discretionary spending. But even in the depths of the pandemic, when commercial aviation essentially stopped, TransDigm continued generating substantial free cash flow from their defense business and from essential maintenance that airlines could not defer. And now let me address the criticism that TransDigm always faces, because I know you will hear it if you research this company. Critics say TransDigm is a price gouger. They say the company exploits its monopoly position to charge excessive prices for essential components. Congressional committees have investigated their pricing practices. The Pentagon has complained about prices on defense contracts. Here is my response to this criticism. In a capitalist economy, companies that have built genuine competitive advantages deserve to earn returns that reflect those advantages. TransDigm did not inherit their monopoly positions. They built them through decades of smart acquisitions and operational excellence. They provide essential components that keep aircraft flying safely. They invest in research and development to improve those components. And they answer to shareholders who deserve a return on their investment. Is TransDigm aggressive on pricing? Absolutely. Is that wrong? I do not think so. They are playing the game of capitalism exactly as it should be played. They built something valuable, and they are capturing the value of what they built. The customers who complain about TransDigm's prices have options. They could invest in developing alternative suppliers. They could work with regulators to certify competing products. They could design future aircraft with components from multiple suppliers, but they do not do these things because the cost would exceed the savings. And that reality that the customers choose to pay TransDigm's prices rather than develop alternatives is proof that TransDigm is providing value commensurate with their pricing. The capital allocation at TransDigm is exceptional management, returns enormous amounts of cash to shareholders through special dividends. They have paid multiple special dividends of $50 per share or more. They repurchase stock when they believe it is undervalued. They make disciplined acquisitions at valuations that ensure strong returns. They do not build empire. They build shareholder value. I have rarely seen a management team more focused on per share value creation. Let me tell you about the acquisition strategy at TransDigm in more detail, because it illustrates perfectly how intelligent capital allocation works. When TransDigm evaluates an acquisition, they do not look at revenue growth potential or strategic synergies or market share. They look at one thing: what is the proprietary content? How many of the target's products are sole source components where TransDigm will have pricing power? If the proprietary content is high, they buy. If it is low, they walk away, no matter how attractive the price might seem. This discipline has allowed TransDigm to build a portfolio of over 1,000 product lines, almost all of which have sole source positions. The aggregation of these positions creates a business that is almost impossible to replicate. A competitor would need to acquire 80+ businesses, integrate them successfully, and apply the same value creation playbook. No one has the capital, the expertise, or the patience to do this. I also want to highlight the resilience of TransDigm's business model during economic stress. During the pandemic, when commercial aviation essentially stopped, many aerospace companies faced existential crises. Airlines canceled orders. Aircraft manufacturers slashed production. Suppliers across the industry reported massive losses. TransDigm continued generating positive free cash flow throughout this period. How? Because their defense business kept operating, because essential maintenance on aircraft could not be deferred, because their cost structure is flexible enough to adjust to lower volumes, and because their pricing power means they do not need high volumes to generate profits. The pandemic was the ultimate stress test for aerospace business models, and TransDigm passed it. The third stock I would own is RTX, formerly known as Raytheon Technologies. This company was formed through the merger of Raytheon and United Technologies aerospace businesses, creating one of the largest aerospace and defense companies in the world. RTX might seem like an obvious choice, a blue-chip aerospace company that every mutual fund owns, but there are specific reasons why RTX belongs in a portfolio of the best aerospace stocks, and those reasons relate directly to the criteria I outlined earlier. RTX operates in 4 segments. Collins Aerospace makes avionics, aerostructures, and mechanical systems for both commercial and military aircraft. Pratt & Whitney makes jet engines for commercial and military applications. Raytheon makes missiles, radars, and defense electronics. And Raytheon Intelligence and Space provides sensors, cybersecurity, and software. This diversification is extraordinary. RTX is not dependent on any single aircraft program, any single customer, or any single end market. If commercial aerospace struggles, defense spending typically increases as governments feel less constrained. If defense spending gets cut, commercial aerospace usually benefits from economic growth. The company has natural hedges built into its business mix. Let me tell you specifically about Pratt & Whitney, because this is where the long-term compounding potential is most apparent. Pratt & Whitney makes the geared turbofan engine that powers the Airbus A320neo family, one of the most successful commercial aircraft programs in history. Every A320neo that Airbus delivers, and they are delivering more than 50 per month, requires Pratt & Whitney engines or competitor engines. Pratt & Whitney has approximately 60% market share on this platform, but here is what really matters. Each of those engines requires decades of aftermarket service. Airlines do not buy an engine and forget about it. They return for maintenance every few years. They buy spare parts constantly. They purchase upgrades and modifications. The initial engine sale is just the entry ticket to decades of high-margin aftermarket revenue. The installed base of Pratt & Whitney engines is already enormous and growing rapidly. Every new A320neo delivery adds another engine that will require service for 25 or 30 years. This creates what I call an annuity stream of future revenue. You can look at the delivery projections for the A320neo, calculate the engines that will be delivered over the next decade, and estimate the aftermarket revenue those engines will generate over their operating lives. The numbers are staggering. Tens of billions of dollars in high-margin aftermarket revenue stretching decades into the future, and the installed base grows larger every month. Collins Aerospace has similar dynamics. They supply avionics and systems to virtually every commercial and military aircraft in production. Their products are designed into the aircraft and cannot be easily substituted. The aftermarket opportunity on these components mirrors what I described with Pratt & Whitney. Once you are on the aircraft, you generate revenue for the life of that aircraft. The Raytheon defense businesses provide stability and diversification that pure commercial aerospace companies lack. Missiles, radars, and defense electronics are essential capabilities that governments will continue buying regardless of economic conditions. These businesses generate consistent cash flow that can fund investment in commercial aerospace during downturns and return cash to shareholders during upturns. I want to address the challenges RTX has faced because I believe in being honest about the businesses I own. The Pratt & Whitney geared turbofan engine has experienced quality issues that required costly inspections and remediation. These issues have hurt near-term profits and damaged relationships with airline customers. The company has also carried significant debt from the merger and various acquisitions. These are real problems that investors should understand. However, I believe the long-term value creation potential outweighs these near-term challenges. The quality issues are being resolved. The aftermarket opportunity on the installed engine base is enormous and growing. The debt is being paid down steadily with the strong free cash flow the business generates. And the Diversification across commercial and defense provides resilience that pure-play competitors lack. Now let me bring these three stocks together and explain the common themes that make them exceptional aerospace investments. All three companies have escaped the broken business model that plagues most of the aerospace industry. They are not dependent on winning competitive bids for low-margin government contracts. They are not constantly investing billions in new aircraft development programs that may or may not succeed. Instead, they have built positions where they have pricing power, where they generate recurring aftermarket revenue, where free cash flow conversion is strong. TransDigm represents the purest expression of this thesis: sole source proprietary components with unmatched pricing power, 50% margins, enormous free cash flow, disciplined capital allocation. If you can stomach the volatility and the political criticism, TransDigm might be the single best business in aerospace. General Dynamics combines defense businesses with insurmountable barriers to entry with the Gulfstream luxury franchise. Consistent cash generation, decades of dividend increases, management that walks away from bad contracts, a company built for steady compounding rather than speculative growth. RTX provides diversified exposure to the best parts of aerospace with an enormous and growing installed base that will generate aftermarket revenue for decades. The near-term challenges create opportunity for patient investors who can look past current noise to the long-term value creation potential. Together, these three stocks provide exposure to the aerospace industry through businesses that actually generate returns for shareholders. They avoid the traps that ensnare most aerospace investors, and they benefit from powerful long-term trends including growing global air travel, increasing defense spending, and the replacement of aging aircraft fleets worldwide. Let me tell you how I would think about applying this analysis to your own investment decisions. The specific companies I have discussed today might not be available at attractive prices when you evaluate them. Markets change, valuations change, but the principles remain constant. When you look at any aerospace company, ask yourself these questions. Does this company have proprietary positions with pricing power, or is it competing for business based primarily on price? If it is competing on price, the margins will eventually compress to unsustainable levels. Does the company generate substantial aftermarket revenue from an installed base, or is it primarily selling new equipment? Aftermarket revenue is the key to long-term value creation in aerospace. Does the company convert its revenue into free cash flow, or does it consume cash in pursuit of growth? Cash generation is the ultimate measure of business quality. Does management allocate capital intelligently, or do they chase growth at any price? Disciplined capital allocation separates great companies from merely good ones. If you find aerospace companies that answer these questions favorably, you have found businesses that can compound wealth over long periods. The barriers to entry in this industry are so high that competitive positions, once established, tend to persist for decades. The key is identifying which companies have actually established those positions and which are merely pretending. I want to close with a thought about patience. The aerospace industry operates on long cycles. Aircraft development programs take a decade. Engine aftermarket revenue builds over 30 years. Defense programs span multiple presidential administrations. Investing in aerospace requires a long-term perspective that many investors lack. When I buy an aerospace stock, I am not thinking about next quarter's earnings. I am thinking about where this business will be in 10 or 20 years. Will the installed base be larger? Will the aftermarket revenue be higher? Will the competitive position be stronger? If the answers are yes, short-term volatility becomes irrelevant. The three stocks I have shared today, TransDigm, General Dynamics, and RTX, are built for long-term compounding. They will experience volatility. Their stock prices will decline during market panics and aerospace downturns. Headlines will question their prospects. Analysts will downgrade them at exactly the wrong time. None of that matters if the fundamental business continues generating cash and compounding value. What matters is the quality of the business, the durability of the competitive advantages, the intelligence of capital allocation, and the patience to let time work in your favor. I spent decades avoiding aerospace because most aerospace companies destroyed shareholder value. These three companies are different. They have built the kind of competitive advantages I look for in any industry. They generate the cash flow that turns paper profits into real wealth. And they are managed by leaders who think like owners rather than empire builders in an industry filled with traps for unwary investors. These three stocks represent the path to genuine wealth creation. There is one final lesson I want to share from my decades of studying aerospace. The industry teaches you that barriers to entry matter more than almost any other factor. When barriers are high, profits persist. When barriers are low, competition destroys returns. The three companies I have described today have built barriers so high that competition is essentially irrelevant. Transdim's sole source positions cannot be replicated without decades of effort and billions of dollars. General Dynamics' submarine manufacturing capability exists nowhere else. Pratt & Whitney's installed base of engines will generate aftermarket revenue regardless of what competitors do. These barriers are the foundation of long-term wealth creation. Find businesses with insurmountable barriers, buy them at reasonable prices, and let time compound your wealth. That approach has worked for me for 80 years in every industry, including aerospace.